When you're going out and looking for something, you really need to understand the value of something so that you can be competitive in your bidding process. And this is literally like the most basic. Understanding that valuation is really key for existing buildings and existing land to 1, de-risk it for you, 2, make sure you can get a competitive bid across the table, and 3, understand who your competitors are. Getting a deal over the line. This isn't about real estate, this is about anything. People are either terms or money motivated, and that is literally everything. If you look at any deal that's created, whether it's Trump dealing with other continents,
no room left for Mexico or for Canada,
or whether it's someone selling something at a car boot sale, you can quantify this reasoning of a sale in any context. And what it is I thought I'd do a little bit of a 101 on how we value stuff. When you're going out and looking for something, you really need to understand the value of something so that you can be competitive in your bidding process. And this is literally like the most basic stuff. And I'm sure there's a lot of you listening to this that are super experienced and thinking that you already know this, but run with me. So we work backwards. So the valuing of a building tends to be the gross development value minus the profit, which we aim for 20% before finance costs as a minimum. Build costs and professional fees, the finance costs and the purchase costs. That's stamp duty, legals, any costs that are associated with the purchase. And then you get the building land value, you get the value of the building. Now, where this is really important to understand when you're looking at a building, this is a building that is an example, the old Maltings in Abingdon being converted to 21 flats and 2 houses, is for us to value that building, we actually got to a purchase price of 1.4 million. Now, what is interesting is now let's value it as a building, not as a developer. So take the developer hat off and now value it as an owner occupier or alternatively an investor buyer. So we take the estimated rental value. Going to do a quick calculation on my phone, about a 10,000 square foot building. So if we do £20 a square feet times 10,000, that equals our estimated rental value. So we reckon we could probably rent this out to a commercial tenant for about 200 grand a year. Now, let's just assume it's a secondary location. When you're valuing commercial buildings, the cap rate or the income multiplier is really tepid in terms of where your location of the building. If it's in zone 1 London, it'll be worth a lower yield and be worth more. If it's a better tenant, it'll be a lower yield and worth more, like Waitrose or whatever it may be. If you're renting the building out to Jim's Taxis and it's him and his wife that are running the business and they've only done 1 year's worth of accounts last year because Jim's just gone from self-employed to running his own business, your covenant strength isn't as strong. So let's say the estimated ready value is £200,000. I'm going to assume a 10% yield on this type of building. So if we times that by 10, you get to a valuation of this building at £2 million. Now, why that's really important is as a developer, we got to a valuation of the building at 1.4 million, but the building as a commercial lease and income is at 2 million. Understanding that valuation is really key for existing buildings and existing land to 1, de-risk it for you, 2, make sure you can get a competitive bid across the table, and 3, understand who your competitors are. Because we were actually outbid on this site by an owner occupier who then ended up pulling out because there's a restriction on the site that you couldn't convert it to anything other than flats and offices, which is, I've never heard of that before because normally it's everything against resi. So we ended up buying the building for 1.4 and we've actually underpaid as opposed to potentially its value if it was let out as a commercial asset. But that's how you value a building as a developer and how you value a building as an investment. Obviously, something's worth what someone will pay for it. So if you bring this to the open market, it's whatever someone is willing to pay for that particular site.
If you get value from these videos, imagine what we could do for your business with more one-to-one coaching. Now, we've spent over £100,000 on training, business coaching, non-exec directors, and we love sharing that information with our mentees. Click one of the links in the description to find out more. Back to the video.
I'm now going to share the 3 things from a deal analysis that we need to see, or I think it's actually 4 things that we need to see to do the deal. This is our internal metrics, which runs our business, makes our deals profitable, and enables us to do deals that other people might not actually consider as a good deal, but we think is a good deal. So starting off, we banged on about this a few times, is we have a stress test model. The stress test model is basically assessing risk against the potential deal going the wrong way. Where this is good is you may look at a deal and go, oh, this feels risky. This feels like a risky deal. Whatever that may be gut, that might be someone told you that, it might be a lot of construction, it might be in an area where sales aren't that active, it could be anything. But this hopefully determines those risks because it scenarios them. So it's a bit like, if you're scared about jumping off a diving board that's 80 feet tall and then you watch someone else do it, you've got the comfort that actually if that scenario happens, you're happy to do that. That's probably the worst analogy I think I've ever come up with, but we'll run with it. So looking at the 3 metrics, we look at gross development value decreasing actually by 10% now. This was probably a smaller deal, so 15% in this spreadsheet. Build cost going up 15%, which is 15% plus our contingency, which is typically 10%. So it's 25% increase in build costs, and the project duration taking longer than we had proposed, normally 50%. Our rule is if all three of these things happen, it's either been a pretty devastating marketplace and deal, everything's gone wrong, and it's been completely delayed, and you still make a profit. Why wouldn't you deliver that deal? So that's one stress test model that we typically use. We also have a annualized return that we focus on in our business. And what I would recommend you do as a developer or business owner is analyze your overheads. Our overheads, let's assume, heads of £400,000. If we're not delivering 3 schemes that return us, for an example, £100,000 per year, we're going to be in the red as a cost as a business. So this is your net income against your gross outgoings. So it's all about analyzing your costs to run your business against the revenue you're going to be generating. Don't look at a deal and be like, it's a brilliant deal. It's 25% on GDV. If that takes 5 years and pays you 50 grand a year and your business costs 100 grand a year to run, you've lost money on that deal. So annualize that amount of income, super important. We also annualize the return for the investor. So when we start out, everything on our spreadsheet is a prediction. This is something that's happening in the future and we don't exactly know where it's going to be, but we can forecast where it's going to be. And to do that, we would like, for 2 reasons, to look at the return on cash for half the profit for 2 reasons. Some of our investors are equity investors and they want to see what they're going to be getting return on their cash. They normally take 50% of the profits and we annualize that. And then the other reason is if we're bringing in it as a loan, we know what we can service a loan at by that deal as an anticipation. So this particular deal in front of you, it looks like we might make 49% per annum, which is great. So if someone approached me and said, I'll lend you the capital, but I want 15% back, I know that we can service that figure. Profit on GDV. Now, this is the most generic one that everyone hears, and I actually referred to it just now at 25% on GDV, 20% on GDV. Typically, it's lenders, bank lenders that do this because it's kind of the leverage amount. It's a good metric for leverage. So loan to GDV, loan to cost, loan to value is a really good metric to understand the leverage position of a deal or a portfolio or a person. And that is why banks and lenders in the finance markets like it. I don't necessarily like it because I feel that there's been a lot of deals. For an example, the majority of the flips that we do in central suites are like 12% on GDV. They are not deemed as a fundable deal in the development space unless you fork out a load of money to have as equity. But as a result, you might not do that deal, but we're making 50 to 80K on these flips. That's good enough. We do 4 or 5 of them a year and we're happy with that. That 12%, yes, when the market goes the wrong way, that's a thinner line, but we are happy with that.
Sorry to interrupt. If you are tuning into this, love the idea of investing in or developing property. You have at least £50,000 cash, but don't have the time to deploy it, then why not consider investing in one of our XP projects? We're always raising more investment for our property pipeline, so head over to our website and register your interest to work with us now. Back to the video.
Getting a deal over the line. This is like one of my favorite areas of just securing a deal. This isn't about real estate. This is about anything. People are either terms or money motivated. And that is literally everything. If you look at any deal that's created, whether it's Trump dealing with, other continents, or whether it's someone selling something at a car boot sale, you can quantify this metric or this reasoning of a sale in any context. It could be a multi-billion pound deal, or it could be a £1 deal. And all of this is really, really relevant. And what it is a vendor selling something is either transitioned, motivated by one or two things. And it's like a sliding scale. So the more that they're motivated to one, the less they can be motivated towards the other. Now, what that looks like is, let me give you a scenario. I'm going to give you a scenario of someone is leaving the UK. They're going to go to Australia and they're selling a car. Now, if they're leaving on Tuesday, they're time motivated and probably care less about money, because beyond Tuesday, the money's negligible and it have to go into storage, or they have to keep it taxed and MOT and insured on the road. So they're time motivated. So that seller is time motivated. The car dealer that has the car on the forecourt of their dealership, it doesn't cost them much to keep it there every week to wait for the right price. So they're money motivated. They're in it for the money. So that is a context of speed and money and how this position works. Someone selling a house is exactly the same. People in auctions are speed motivated. People that sit on Rightmove for 6 months are money motivated. And what you can do as a buyer is create the deal around that. And the way that we do that is, if it's been sat on Rightmove for 6 months, we'll give them the price that they need, but we'll have conditions. Those conditions might be delayed completion, low exchange funds, subject to planning, vendor finance, JV, whatever it may be. I don't really care. But how can you make that deal work so that you are giving them what they need because they're money motivated, but you've completely adapted the terms to suit you and actually reduce your costs, so that that difference in cost doesn't actually cost you any cost. The principle of this is understand what they need. And the way that we do this in our business is we typically do a dual offer, which is basically, and this is our kind of like generic offer sheet, we will offer something unconditional and conditional. And the uncon is normally speed, conditional is normally the money, the slower. Obviously, if you delay a purchase for 16 months while you're getting planning and while you're tendering and while you're doing bits and bobs, you're saving all of that on finance costs. That is how we do it. We do a dual offer, which is basically offer A, offer B, and essentially the vendor then comes back, believe it or not, and they either say no to both, but your job is to try and get the preference. Which one do they prefer? They also complement each other, because the lower the uncon bid, the better the higher bid looks, and it kind of softens a cheeky bid or a lowball, as people, I hate the word lowball. I feel like the terminology lowball is just when someone decides to pay less than what something is worth just because they've seen the price and they want to knock 20-30% off it. That is not how we get to our pricing. I have bought stuff that people would say is lowballed, but there's actually like method behind it. I go, well, actually, this is how it works for me. That's it. Rant over on lowball. Back to dual offers. They complement each other. One's obviously higher with some conditions and one's lower. What you normally get is then feedbacks. They go, actually, offer B is at the right price, but we can't do 12 months. We can do 6 months. And you're like, okay, we're working with something here.
If you got value from this video, make sure you click the subscribe button down below and ring the notification bell, because we release one video at least every week, so you'll be the first to get notified. See you on the next one.